Hi, Steve Van Metre here, and welcome to your Wednesday night premiere. We take about 15 minutes every Monday and Wednesday night. Try to make sense in markets that really don't make any sense. And how can you when there was literally no good economic news this week? None Monday, none Tuesday, none Wednesday. And what do you have? You have stocks going higher. And now 4 stocks represent 17% of the S&P 500. So people out there, they're investing in index funds, think, man, I'm safe because I'm diversified. No professional money manager would ever put 16% of a client's portfolio in 4 or 17% in 4 stocks. They wouldn't do it. But yet people are doing that today, and they don't realize that part of the reason this is occurring is because all these various computer programs that were designed to protect by the boomers, to protect them from the mistakes they made in 2000 and 2008 of being overweighted in equities, are now overweight equities. So those formulas that have all these various look-back provisions, I mean, it's like this. It's like driving your car like this. Oh, well, look, there's no stop sign. Oh, well, there's one. Like, that's how these programs work. And so some of them that are buying right now have 2-year look-backs on volatility, and they're already very highly weighted in equities to begin with. So it's not like they're in 20% equities and they're leveraging and they're just buying. They're, like 65% to 70% equities, which is on the upper end of their normal extreme level as these programs will do. And now they're leveraging. They're having to take leverage positions because what's happening, there's a tail risk of volatility that's going down. And their formula says, hey, look back. Oh, volatility's dropping. Well, then it's going to drop going forward. And the market's reporting this, or the media is reporting this as, well, the market's not concerned about the coronavirus. Well, it should be. You look at these factories. There was a factory in China that reopened. One person is suspected to have the coronavirus. All 200 people are now quarantined in the factory. Now, maybe none of them have it. Maybe one of them does. I don't know. But you're starting to hear events, hotel chains, everything's is getting shut down, not for a week, not for a month, but for several months. This is going to have a monster impact on corporate profits, on corporate earnings, the entire supply chain, dollar liquidity, the works. But because so many people are used to the market telling them when they should feel good or bad, they look at this and say, oh, the market's up. Well, coronavirus must just not be a big deal. It's not really having any problems because the market would know. And it would. If it wasn't 80% traded by computer programs, it would know. Where are the other 20% of the people? They're in bonds. And you say, well, wait a minute. It's true. I just saw a video that was published by Real Vision, their CEO and founder, Raoul Pal, and he showed a chart of equity ownership and bond ownership, and 80% of the investors owned equities. Well, guess what? 80% of the market's controlled by computers. Where's the other 20%? Well, it's people that probably are not computers and know what's really coming. And we know that because we've been looking for years at the smart money who've been buying bonds all through late 2016, 2017. We're buying more through 2018, buying a whole bunch in late 2018, late 2019, early 2020, and are now buying again because they know when this whole thing goes away, it's going to be a deflationary shock, and these computer programs are going to go from buying to rapid selling. So you're only seeing them buy a little bit every day. You haven't seen when they all do 180 and push the sell button simultaneously. Now, I want to talk to you about the job openings and labor turnover survey. It's something I've never written about, never looked at a chart on, and it's worth looking at because there's something interesting that happened this week. Is we had we had a big drop off in job openings for not for 1 month, but now 2 months in a row. And there's a chart circulating by a really, really smart guy on Twitter. If you're wondering, I'm nursing a sore throat, so if I look funny or I'm acting funny, that's what it is. And my friend in Hong Kong, who I know is listening to this, will know exactly who I'm talking about. He uses the title Plunge Protection Team, and his handle is like @GameBlazer or @Game something or another. And this guy is a really smart dude. I mean, I love his content. I love what he posts. I can't say I understand it all, but I do really enjoy it. And he was circulating a chart, and I want to up the ante on his chart. And it was based on the job openings labor turnover survey. And he was citing that the recent decrease into it had something to do with the yield curve. And maybe my friend in Hong Kong will post this chart, or he'll make his own and maybe post it, and he doesn't have to give me credit. But it'd be cool if he did. It doesn't really matter because I obviously can't post on Twitter due to compliance reasons. But anyways, here is the chart that he posted. So here he says job openings. Now I made this one. It's just a copy of what he had. Total non-farm, and you can see this big drop off in job openings. And mind you, this is Janet Yellen, former Fed chair, her favorite survey. So this is telling us this is a problem because while this survey has not been around very long, you can see when it starts to go down, you enter the recession shaded areas. So Game Blazer said, look, when the yield curve inverts, which is this red line, which is the 10-year minus the 3-month constant maturity rate, he said it starts to set the stage for the next recession and job openings going down. And here you can see, here's the inversion, and it's down here. You just can't really see it because this as far as the JOLTS data goes. And I like to look at just what we can see here. So you're seeing the most recent inversion, and right on time, you're seeing the JOLTS survey. So you say, wow, that's really smart. And like I said, the dude is really smart. Now let me show you a much easier way to look at it, because those of you who know, I believe very much that it is the Federal Reserve who ends up inadvertently tightening financial conditions when they try to ease in the midst of the monetary lag. So here we are in somewhere in the middle of this, tightening cycle that the Fed put us through, and they're trying to ease. Well, when they ease, when the economy is feeling the effects of tightness, it actually further tightens the economy and leads to a recession. So the Fed inadvertently causes a recession that they're trying to starve off, that they would have caused anyways. So I believe you can see this in a much clearer picture by looking at the federal funds rate. And here you can see is when the federal funds rate is rising, job openings are rising, and the federal funds rate plateaus here. And look at that, job openings plateaued, and the federal fund rate goes down, and so does job openings. And here you see you can almost target the peak of the job openings right where the federal funds rate peaked. And as the federal funds started to nudge down, part of this was due to their QE program, and then the Fed lowered, and boom, there you see it. So what does this tell us is that when the Fed ultimately brings the federal funds rate back to zero, and they will, we kind of learned that today in Jay Powell's, the current Fed chair's testimony to Congress. He said, look, the zero interest rates aren't going to be enough. We're going to do some massive QE if we have another session. Well, there's no choice. Because what does QE do? It causes interest rates to go down. So when you're already at the lower bound from the prior cycle, you can't spur lending growth unless you go below it. That is how debt-based economies work, and why since 1980 you've seen perpetually lower interest rates. It's just a function of, to get you and me to go borrow, we need lower interest rates, right? I mean, just think about this. If mortgage rates were 7%, would you buy a new house? No. Would you refi? No, unless you had no choice, meaning you were moving. And then you would think twice about it, because you'd be like, well, I don't know if I want to give my 3% mortgage for 7. How well do you think automobile dealers or car manufacturers would do if auto interest rates were 10%? They're probably not good. How about other rates for home equity lines where they were 15%? Would people buy and put pools in and additions and do other things? No, they would not. So how do you spur people to do things that they normally wouldn't do? Is you lower interest rates. Because if interest rates were constant, then you wouldn't see the spike in demand from lower interest rates. It would level out somewhere, kind of like it is now. The economy is trying to level out, but the economy has to shrink down to whatever the level of interest rates need to be, and that's what it's trying to do. You don't see that in the stock market, but this is exactly what is going on right now. So there's my up the ante to Game Blazer, really smart dude. And I certainly don't want to take away anything from his research, but I think this really simplifies it and tells us that job openings are headed much, much lower when the Fed does cut rates to zero, and when they fire up the QE engine, which everybody thinks is bullish for the economy. Well, it's not until it is, and it's not until the monetary lags pass through. So let's take a look at the manufacturing sector, seeing a big drop off here in job openings. And again, all this is telling us is this goose is cooked, and the recession's in the cards. There's really nothing the Fed can do to stop this. So Let's take a look at the economic calendar. Today I want to look at mortgage purchase applications. These are spiking. They were spiking. They're coming back down. Now, this isn't really a lot. I mean, it's a lot compared to where it was, but nowhere near the dot-com bubble, or not dot-com bubble, the mortgage bubble in terms of new mortgages. You can just see that. But it's starting to come down. And when new mortgages go down and refinances go up, what it does is it tells us that 30-year interest rates need to go down. And the simple reason is a bank has to hedge against whatever a borrower is doing. So let's say you have a 15-year mortgage and you're refi. Now, you're going to refi to 10? Probably not. Let's say you have a 20-year. You refi down to 15? Probably not. It's really cheaper just to make extra payments. I mean, if you have a 3% mortgage or 4% mortgage, it's not worth the refi cost unless it's totally free, because you might as well just make the extra payment. So when you see a surge in refinances, what is that telling you? It tells you that people are going from wherever they're at now to 30 years. And what does that tell the bank? Well, let's say the bank's got a matching maturity, a loan and a matching maturity 15-year Treasury bond or Treasury note to hedge that risk. Well, that means the bank needs to get rid of the Treasury note and go to a 30-year Treasury bond as the refi kicks out the term to 30 years. And why would people be doing that? Because the economy is not booming as nowhere near what everyone thinks, and credit card interest rates are super high. So people are most likely taking advantage of the equity in their house. Now, is this big refinance spike pretty big? Yes. Is it as big as we've seen it? Not historically, but it is pretty big. It's a telling sign, because when people refi, guess what they don't do? They don't buy new homes, right? They stay where they're at. Why would I refinance my house and then move? I wouldn't. So it's a sign that consumers are tapped financially and they're staying in place. Now, see, you can go back to the mortgage bill and say, well, people were fine in buying things. Yeah, they were. And you could also look at hours worked and wage growth, and you could see that they were all in sync like that. Today, you don't see that. You see hours worked declining, wage growth slowing, and refinances up, because while interest rates have gone down, credit card interest rates have not. Let's take a few minutes to look at some couple of charts real quick. Here's the VIX going back 2 years. So here's that tail risk of the VIX that is going down, that's causing these computer programs to over leverage themselves at a time which may look extremely foolish. Extremely foolish. Whoops, that's a 1 minute chart. I meant to go to the 1 year chart. Here's 10-year Treasury yields. And we're going to look at the long bond in a moment, but let's take a look at 10 years. So we went through this big drop in yields, a long consolidation pattern from late 2019 all the way into early or mid-January. Yields fell, and now we're in another consolidation pattern here, and I'm going to show you that on another slide or another chart. But let's take a look at 30 years, same exact pattern, and now we're consolidating. So what does this mean? Well, it probably means that people think interest rates are going up because, look, it bottomed here, and there we go. Well, hang tight on that theory, because here's TLT. This is the easier way to look at it. So you see this rally in bond prices. Then you go into this long consolidation pattern where the smart money is buying all these bonds up in here. Now, how do we know that? Because we can look at the speculative positioning, and we know hedge funds are net short the bond market. So we know they were selling. We also know for a fact that thanks to Charlie McElligott of Nomura, that their quantitative bond programs were selling through here. So if theirs were, that means others were eventually selling, because they're using very similar formulas. Now, coincidentally, around the time the coronavirus makes the news, all this buying is done, the sellers are done, and prices rise. So let's zoom in here. And what we have is a new consolidation pattern, and this is really important. So we broke up to near the prior all-time high, which this was an area of resistance. Why? Because there were sellers here, sellers there. Whoops, let's go there. So we see some selling here, and selling here. So the market's saying, hey, maybe there's still some sellers here, and there were. And they sold down to right this point here. Now, why does this point matter from a technical standpoint? Because these sellers wanted to find out if these people who sold here, and maybe some over here were interested in selling again. And what did we find out? They weren't. So prices went up, and I said, look, they look for them to retouch that recent high. Well, it didn't get there, and almost got there, and then started selling down. And what are you starting to see? To see this like snaking pattern where it's coiling? If we drew a line here and a line here, you'd get a triangle pattern. So what is happening right now is the smart money, the big, deep-pocketed investors who want to own a lot of bonds, are pulling the last of the inventory out of these sellers. So you see them selling here, and you see some selling here. And what did you get? You get a very good 3-year Treasury auction yesterday, a very, very strong 10-year Treasury auction today. Tomorrow you get a 30-year Treasury auction. And I'm guessing the results will be pretty strong. And then pretty much at this point, what you see is the market is run out of sellers. And so the fact that it didn't go all the way up is fine. The fact that it's better that it doesn't go all the way down, because what it's saying is we're in this coiling pattern. And when you have a major bottom, let's zoom out here, followed by a consolidation pattern that broke higher, followed by another consolidation pattern here, it tells you what you need to know, and that is interest rates are going down. And bond prices are about to hit a bull market and yank the biggest rug out from the equity market in history. Because when all these computer programs decide to sell, all these people crammed in to have the S&P 500 and have 4 stocks representing 17% of their portfolio are going to find out what it means when everybody pushes sell and there are no buyers left. So I'm Steve Van Metre. Thanks for taking the time to watch. We'll be back Friday with our weekly economic update. The content of this video provides educational information only. It's not intended to provide investment or other advice. It is not to be construed as recommendation or solicitation by or security, financial product instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. The opinions expressed in the video that I don't do not reflect the view of Alice Financial Advisors Inc. or Steven Van Metre Financial.